You will find the link to beginner DAO guide in the description and pinned in comments below. During every crypto bull run, money doesn't just flow up, it moves like clockwork. Smart traders quietly rotate capital from one sector to the next. If you miss that rhythm, you miss the biggest gains. What they do next looks like chaos, but it's actually a secret pattern. Capital rotation is the hidden rhythm of every bull run. In this video, I will show you what capital rotation is and why beginners get crushed by it. I will reveal three rotation patterns that create the biggest winners and one pattern almost nobody notices. I'll give you a simple playbook you can use on your next trade. Stick around because the last pattern could double your returns or protect your portfolio. If you want simple cinematic crypto lessons that actually help you trade smarter, subscribe now. We post one practical breakdown every week for beginners who want to avoid expensive mistakes. Most people think bull markets lift everything, but that's wrong. Capital rotation decides who actually wins. Capital rotation is just money moving between sectors like large caps, altcoins, DeFi, meme coins, and NFTs. Imagine a flashlight in a dark room. Wherever the light moves, things warm up. In markets, capital is the flashlight. When the light swings, winners change. In 2017, ICO soaked up capital. Then in 2020-21, capital flowed from Bitcoin to decentralized finance and NFTs. Each phase made early movers huge returns, and latecomers lost momentum. Think about sitting on a coin that looked unstoppable and then watching it stall while another token rockets away. That pain is avoidable if you recognize rotation early. Next, I'll show the three rotation patterns that repeat every bull market and the one most people ignore. Pattern 1 is conservative and it usually begins with Bitcoin. Don't mistake conservative for safe. In early bull runs, Bitcoin rallies first, but because institutional flows and macro catalysts push it up, as Bitcoin climbs, profit takers look for higher returns and move capital into large cap altcoins like Ethereum and major layer ones. This is a slow rotation where big money tests risk. Remember late 2020 when institutions ramped into Bitcoin, and by late 2020 to 2021, Ethereum's gas story and DeFi exploded as capital rotated. This pattern tempts beginners to chase the hottest coin after it's already been bid up. That's how you buy high. In the next section, rotation gets wild and fast money into smaller caps makes the real fireworks. Alt season is where fortunes are made and lost, and it is short, brutal, and loud. After capital moves to big alts, momentum and leverage create a vacuum into mid and small cap tokens. Social hype, influencers, and TVL spikes attract retail money, and rotation accelerates. These phases last weeks to months. Returns are massive, but volatility is extreme. Think of a wildfire where winds push flames into new areas and money is the wind. 2017's ICO pumps, 2021's MEM and DEFI pushes, and mini cycles in 2023 all had fast rotation phases. You will feel FOMO like never before because every post promises the next 10 timer, 100 timer. That emotion overrides logic, and novices pile in at the top. The final pattern is the quietest, but it's the most sustainable and often where pros lock in the biggest multi-year gains. This quiet pattern looks boring, but it often wins over 5 years. Value rotation happens as capital flows into real utility projects with active users, revenue, or novel mechanics. Investors in this phase care about metrics like TVL, active addresses, revenue, and on-chain adoption. Projects that focused on product market fit after speculative phases often survive and compound returns over years, not weeks. This pattern demands patience, and you will feel doubt as pumps happen elsewhere, but time often favors quality. Now that you know the three patterns, here is the twist most beginners miss. Most beginners treat rotation as a signal to buy everything that's moving, and that is the mistake. The real secret is capital allocation timing: when to hold, when to rotate, and when to exit. Huge gains come from timing risk exposure, not chasing every trend. A trader I coached kept selling winners too early and buying late. After we switched to a rotation plan based on risk buckets, returns stabilized and drawdowns shrank. I'll give you a simple 5-step rotation playbook you can use right now. This playbook is 3 rules and 2 checks, and it keeps you alive and in the game. Step 1: define risk buckets: 60, 30, 10. 60% core for Bitcoin and top blue chips, 30% growth for Ethereum, major layer 1s and proven decentralized finance, 10% speculative for small caps and meme coins. Step 2: use triggers, not emotions. Triggers are on-chain flows, volume spikes, TVL changes, and macro catalysts. If BTC dominance drops and ETH TVL rises, shift 10% from core to growth. Triggers stop you from trading on impulse. Step 3: scale in and scale out. Add gradually and set partial profit targets. Lock gains instead of going all in. Scaling reduces the risk of buying the top during fast rotation. Step 4: time horizon rules. Core is multi-year hold, growth is months to a year, speculative is days to weeks, and requires predefined exit points. Matching time horizon to bucket keeps you anchored. Step 5: a risk management checklist. Set max position sizes and stop loss discipline. Stress test scenarios and never risk more than you can afford to lose in speculative positions. These rules turn random bets into a plan. Follow these rules and you trade with intent, not panic. That alone reduces emotional losses by a lot. Before you use this playbook, I'll show one small hedge pros use during rotation extremes. If you want to protect gains during rapid rotation, use a small hedge. Short a portion of the market via an inverse ETF or a perpetual short to keep cash stable coins ready. It sounds boring, but it prevents catastrophic drawdowns. The real secret is bull markets reward timing and allocation, not perfect picks. Capital rotation is predictable once you watch the flashlight and not the noise. If you learn to read the light, you will stop chasing and start compounding. You won't feel FOMO as badly, and you will feel control, because control in markets is more profitable than luck. If you want more breakdowns like this with simple frameworks and cinematic storytelling, subscribe now. Join hundreds of beginners who trade smarter, not louder. If this playbook helped you, like the video to help others find it. Before you move funds, watch the next video called Emotional Discipline Techniques for Traders. It teaches the mental rules that stop panic selling and turn this playbook into real returns. Click the next video now, because it could save you from one of the biggest beginner mistakes in crypto. Thanks for watching and trade thoughtfully.